Okay. Okay. People online, you can hear us still, you're good? Yeah, okay, cool. Got one camera. All right. Go ahead and introduce yourself real quick.
Yeah, how's it going, everyone? My name's Ben Stegman. I'm actually a senior here at Babson, and just a little bit about myself. I'm a part of the Babson College Fund. I work with the quant team there. On campus, I work with exchange students, and that's pretty much all I'm doing. And
He also works here.
yeah, I also work here at the Cutler Center.
My name's Tyson Corner, also in the Babson College Fund, member of the Comm Services team. I also run a program called Spear here at Babson. So if any of you are interested in doing investment banking, those applications will be coming out soon. And we would love to take more people. So without further ado, we're going to go into some of our FactSet screening today. Ben's going to walk us through a little bit about why we screen, okay, what the point of it is, and then we're going to show you a screen that we've used sometimes, and remember that screens aren't perfect, okay? So we're going to show you some examples of when screens may not outperform, but there are pieces within the screen that would outperform, right? So it's about picking the right company within a screen, not just picking the entire screen, okay?
Yeah, and so just for those of you who aren't sure exactly what a screen is, it's basically what you're doing is you choose a couple metrics based off like how a company performed, and you're looking for all the companies that share those specific set of metrics. So for example, if you're looking for companies that are profitable and have a certain net income margin, well, you could find ones that have greater than 10% net income margin, and it would just return all the companies with that. So it depends on like what strategy, what companies that you're necessarily looking for, and it will help you narrow down your list so that you're not looking at all 8,000 like tradable securities that are on the American exchanges. But a good thing that goes hand in hand with screening is actually backtesting. And so backtesting is just a method to see how well one of your screening models will perform in the past. So what this uses is all the historical data that's been collected for many years, and that's what it's used to run the backtest models. And at the heart of it, what it's doing is it's showing you how viable a trading strategy is, meaning that would this outperform in the long term? Is this just outperforming this year, or is this actually a good method for finding good quality companies that if you invested in, you generate outsized returns versus the market? And so just with this example screen right here, our backtest on Bloomberg, you can see that it actually ended up outperforming the market. It gave a total return of 157%, which is the one in the upper hand corner, over the past 5 years. And so as you can see, key metrics on that one would be like Sharpe ratio at 1.5. The overall market Sharpe ratio is 0.68. So as you can see, it's performing better on different areas. And all this was just a basic momentum screen. And so basically how to perform backtesting. In FactSet, which we'll be getting to in a second, there's something called alpha testing 4, but not everyone has access to that. And so it's sometimes a little hard to do, but you can actually easily perform a backtest like the one I showed in Bloomberg using the EQBT function. And that equity backtesting function, you can do it on pre-made screeners that are in Bloomberg or a screener that you make using the EQS function. And if you wanted to, there's another way to backtest, and that's manually doing it. It's super time consuming, and it can be very subjective. So I wouldn't suggest it, but if you want to do it, more power to you. And another thing with backtesting is you can change on how you sort of want the strategy to do it. Some people, if you're going for like a long-term investing, you may want to rebalance, meaning like it will buy and sell and look for new ones every year. But you can even go down all the way and look for new ones every week. And so you can change that, and you can also change how it's weighted. You can have it all equally weighted so that if it finds a company that meets your criteria, has equal weight in the portfolio, or it can be weighted off market cap, or pretty much however you want in that. And so just to note that when you are backtesting, there are certain pitfalls that come to doing it. And so I think I briefly mentioned it before, but the time period does matter a lot. So if you're trying to screen for good companies and say you just look back this past year, Well, that wouldn't be a good example of a variety of different markets. And what I mean by that is sometimes there's bull, bear, or sometimes horizontal markets. And this past year, we've seen an incredible rally off the March bottoms. And so certain screeners that may outperform over 10, 20 years probably might not have done too well over the past year. And so it's really important that you have a good range that captures a wide variety of scenarios so that you know that your screen and your back test was very good. Also, when you're building the model, it's sometimes tempting to run a model on a set of data, say like the past 10 years, and then you find you're like, oh, if I alter this just a little bit and you just start playing with it, basically what you're doing is overfitting it and you're just tweaking it to perform really well during that time. And everyone can do that because, and it doesn't necessarily mean it's good in the long run. And so basically what you shouldn't do is take the information on this model to build a new one. Because if you do that too many times, then you'll end up overfitting the data. And of course, you'll come up with something that outperforms the market in the long term over that period. But going forward, it may not be very good at all. It might drastically underperform.
Another thing to just keep in mind is that when you screen, what's left is like a survivorship bias. So the only companies that are staying over that period actually survive that whole period. And when you're picking individual companies, that may not always be the case. So you need to make sure that you actually do research along with your screens to make sure that what you're picking can survive over that time period. Because if it can't, your survivorship bias from there might let you think, oh yeah, all these companies made it, but they actually didn't. And so you got to make sure that you're paying attention to what's going to be around in 10 years if that's your time horizon.
Yeah, and we'll get that with the exclude inactive securities button for FactSet. And then the last big one is the look ahead bias. So what that's taking into account is, companies release quarterly reports, and during that time, you have information during that in between that you didn't have previously. And so if I'm screening for, say, price to earnings, just for example, and I'm not lagging that by 45 days or almost 3 months, then I run into the possibility of having information now that I didn't have back then, and that can actually influence the screen and make it perform better than it actually would have because you have information that you didn't have back then. And so that's a pitfall. And so just what you can do is just do a variety of back tests. The last one is I mentioned it before, but doing a variety of back tests on the same data. Make sure you switch it up and don't overfit it. So when you're actually doing the back test, sorry, this was like a little blurry on my screen, but this is from the alpha testing in FactSet. And what it does is it can break down all the factors that you screen for. So I've just been throwing out like price to earnings, but you can put as many as you want. So in this one that we did, we actually ended up doing around 25 different factors. And basically what these bubbles are showing is which ones contributed the most to the outperformance. And so from there, it can give you insight onto seeing like where it's coming from. And you can ask yourself, does this make sense in the market that we're seeing? And so in these, we've seen a lot of outperformance in terms of like momentum and growth. And you can see that those are doing really well, while ones like value are actually sort of falling off recently. And so that's just an example on that one.
Can I explain what that means real quick?
Growth versus value.
Yeah.
Yeah. So with growth, so these are companies that when you look at them seem expensive, but the thing is that because of their potential growth in revenue and potential growth in earnings per share, people are willing to pay high multiples for it, and they're not looking for like the dirt cheap like multiples that you see on like Intel or Cisco right now. We're thinking stuff like CrowdStrike, CRM, a bunch of like the big names that you probably heard in the tech space. And that's what they're saying is that because of the growth, people are willing to pay up for it, and it's seen a lot of outperformance. While value, people haven't, it's not as flashy, and so people aren't really going for it, aren't really looking for it as much. And so that's really the difference, at least in terms of performance that we've seen. But here's an example, and Tyson alluded to it before, is that you can break down each return into quintiles. It's just like, I don't know why it's not quartiles. It's just industry standard that they use quintiles. But you can see in here that and what this is meaning, it's like, if you have, to stay with the price for earnings, you have price for earnings of a set of companies. But if you break that down into the different areas, so say you're looking for like the lowest quintile, the second lowest quintile, third lowest, and you break them out that way, and then you run the performance on it, you can see that there's a large disparity between the quintiles. And you can see that for quintile 1, in this respect, it performed drastically better than all the other ones. So what this can tell you is that while maybe just by screening for price to earnings overall might not have generated outperformance, but if you did price to earnings in the top like 2 quintiles of this, then you know that you would have gotten outperformance in there. So while your back test might show that your screener's not performing well in the overall, if you look and dig into the quintiles, it can actually show you that no, in fact, you were right. It was good. You just have to choose the top, the best, the highest quality in this screen in order to generate that outperformance. So, and then this is just a breakdown, more on the performance itself, because sometimes you can see like returns aren't everything. It's also important to manage your risk. And so what this can tell you is that how much you might be generating excess returns, but if you're say a mutual fund manager or you're trying to manage an endowment, you really don't want super crazy volatility in there, because it's not very good. You want stability in that. And so what this can tell you is that you can help find that mix. Maybe quintile 1, really good returns, but really volatile. So it's not necessarily the best. But quintile 2 still outperformed, but you get so much better risk-adjusted returns. And that's what you can see from here. It's color-coded, more green, better risk-adjusted. Red, not as quite risk-adjusted, even though that you might see some of the higher numbers for down there towards the bottom on some of those factors. But in terms of risk-adjusted, you might not be as interested in those as the other ones. And so that's just a quick intro to backtesting and why and how it goes hand in hand with screening. And it's a very important tool, especially when you're considering new strategies and thinking up of new ideas and how the market might be moving in the future.
Yep. So before we jump into FactSet, any questions from the group, online people? Anybody have questions about anything that we just went over before we jump in?
Grant has one.
Hi, I have a question about the backtesting. So the information about backtesting screening is very great, but I'm wondering like how really useful is backtesting when you have companies like, I'm just gonna give an example like Amazon, for example, and this is like a period of 6 years where you have AWS doing like 4 or 5 billion revenue, and then now 2020 doing like 45 billion revenue. So it's just a different like company. So how useful is really the backtesting when it's like, you know, like NVIDIA, they'll be 10 years down the line, such a different company by like a wide margin. And like they're kind of, so as I've been for certain companies, like I guess it's like stable revenue segments and different business models, it makes sense. But I feel like for companies where it's more high growth, like always adapting, it might not make as much sense to use something like backtesting. It would be great if you could give your opinion on that.
Yeah, so on that one, that's actually a really good point, is that, yeah, companies do change drastically and how they trade. Like certain companies, like I'm sure you've seen with MasterCard and Visa versus American Express. MasterCard and Visa are trading like a fintech company, even though they're a credit card company very similar to American Express. And American Express is trading like a financial, almost like a bank in that respect. And so you do bring up a good point there. And what I would say to that is what you would be doing on your screen in your back testing is, if you believe that there are companies like that, there's definitely telltale signs that they are heading in that direction. And that's what you would be putting into your screen. You'd be looking for the companies that have that kind of potential for that potential of growth and the way that they adapt. And what I'm meaning by that is saying that, yes, you might be screening for these general type of companies, but you can tell like when a company is going to go through a large change based off of different ways that they're investing their capital, the amount of return that they're getting. And so what you could be doing with your screening for back testing is actually looking for those companies that are in those transition periods. And then that could be the ones that tell you that you're looking for. And so like, yes, back testing might not get you all of them, but it can help you look for the companies that are going to go through that change. And that's maybe what your screener is doing. Because you can do a variety of screeners for anything. Value, you could screen for companies that are potentially in transition periods. And I know there's people like in the private equity space, they look for companies that are very undervalued, mismanaged, have a lot of cash, stable business, and then those would be a leverage buyout opportunity. And so it just really depends on what you're looking for in the company, and you can really adjust your screener, and then your back test can just either confirm your suspicions about a certain strategy or what might be working. I hope that answers your question just a little bit.
Yeah, and I'll
Yeah,
just
thank you.
add a
That
little
was really
bit.
great. That was really great. That was
Okay.
good.
Never mind.
I don't know what you're gonna say.
Oh, okay. Well, I was just gonna say, like, when you have the growth, like Amazon would fall under like a growth style company, right? Not a value style company. So knowing what you're screening for, as Ben was saying, is important. Like you can run certain screens that are looking to identify growth companies similar to what we would call the next Amazon, right? You don't necessarily want to own the next Amazon, but finding something that's going to grow like that, grow with their stock price like that. So in your back test, you see that maybe, you know, if I own the top 10 growth companies, this is how they would perform compared to the market at any given point in time. And maybe if you can isolate them beforehand, maybe instead of looking for price to earnings, you look for revenue growth rates, right, within your screen. And then you back test based on those rather than some of those value factors to identify growth stocks. And then your back test makes more sense for what your investment strategy looks like.
And I didn't really get into it, but you could actually reverse engineer it. So you could say like, I know that Apple, Facebook, Amazon, and a list of other like CrowdStrike, Salesforce, like all these other stocks that performed really well. You can say like, okay, what's the common denominator of these back before they had their explosive growth? And then you can reverse engineer it and basically say like, okay, these are the factors that were good. So I'm going to screen for them and see if this was truly why they outperformed, or if there was something completely else that was going on during the time that didn't be captured. Because if there is like a common denominator, then that could be your screener for looking for the next Amazon, as Tyson said.
Okay, yeah.
Awesome.
Okay, yeah. Yep, good.
Okay, and then for those who have FactSet, why don't you open it up right now so you can follow along? I'll pull this up. Just realized it.
And I'll be watching the chat if anyone wants to drop anything in there as well.
Oh, cool. Okay, does everybody have FactSet open in the classroom? Yeah, good. Online folks who have it, you're good? Okay, cool. So what we're gonna run through today is called like the magic formula screener, basically. And so in Bloomberg, magic just kind of exists. I think you could type in magic, right, on EQS, and you can pull it up like that. In FactSet though, you're gonna have to create it yourself. So we're gonna show you how to do that. Okay, so what you're gonna wanna start with is this criteria button, okay? So what you're gonna type in is price, right? And you immediately see price to earnings, okay? This fundamentals one, all right? Click on that, double click on that. Click into the formula and just put greater than 0, okay? So if you put greater than 0, what does that mean? That means that your company's earnings are going to have to be greater than 0 so that that price to earnings shows up as a positive number, right? So you're just screening for something with any earnings. If they have any earnings at all, we're including them into this group. And then just click enter, and then it should come down into the bottom, down here. Okay? Next up, everybody good on that? Okay. Next up, market value. Okay? And we'll go at the company level, double click, right? We want this to be greater than, in the BCF, you can't pitch anything that's less than 100 million, right? But for our purposes today, we're going to do 150 million. Okay? So then put in 150 and click enter. Okay? And then the last thing that you're going to want to do, just to make sure you have all the companies that are trading that you can actually get, is just start typing out United States. Okay? And then there are a lot of different ones here. So you see this says geography, but that means where the company's located. You don't necessarily want where the company's located. You just want to make sure that they trade on a US exchange. Okay? So look at this right part and you see exchange. Double click on that. Okay? And it should come down to the bottom. And then those three criteria will help set the basis of the companies that we're going to look at. Okay, so you should have around 2070 results given what you have down here. Okay, then we're going to go into the format results tab. Okay. Well, actually, sorry, no. First, before we do that, let me bring you down here. You need to add a column. Okay, so what we're looking at in this magic screener is called ROIC. Okay. So you type in ROIC, right? And you see return on invested capital. Okay? And these are FactSet estimates. So these are forward year return on invested capital estimates that are within FactSet. Okay? Double click on that. And then click enter. And you should see a column come up here on the side of FactSet that says ROIC mean, right? Fiscal year 1. Does everybody see that when they click enter? Following along? Okay. So now you have ROIC, you have your, you've screened down, you're down to 2,070 companies, right? And that's mostly because of how liberal we were with the market capitalization, right? 150 million is still a pretty small company in terms of what you're looking for on a US exchange. All right. But then you want to start formatting the results. Okay. So you have this ROIC, you want to have it formatted, right? So double click. Go ahead.
Say why we want to format it.
Oh yeah. Yeah, I will. So first just double click and get the top ROIC at the top. What is this doing? Right? This is bringing the companies with the highest return on invested capital to the top of your screen. Why does that matter? Well, in this magic formula, we're looking for companies with top ROIC. That's what we're screening for. That's what we're actually looking at, right? So we want to put this where we have top ROIC at the top because we want to make sure we're picking companies with the best ROIC. That's what we screened for in this instance, okay? So we made sure that companies were what? A, profitable with a price to earnings of greater than 0. That we want to make sure that they're generating some type of earnings, okay? Then we have return on invested capital. Does everybody know what return on invested capital actually means? Yeah? Like everybody's seen that formula?
Seen some thumbs up.
Okay, cool. Perfect. All right. So we have that. We have our formula. Now what we're going to do, right, if you double click on that ROIC thing, if I double click right now, it'll go from low to high, right? It would flip this order. But if you double click it initially, it'll make it go from high to low. So you should be seeing the exact same screen that I have here with 131.8 at the top. Okay, but you won't have these ranks, right? So how do we rank our results? Okay, so you come into here and you click on, so this would be over here initially, right? Click on it, click this little arrow, sends it over, okay? Then what you're gonna wanna do is click rank over here, okay? Does everybody see rank, the rank button? Okay, so click on that rank button. Then you'll get a thing that says ranking options, okay? And we can name it whatever we want. We can name it ROIC Oh, never mind. Guess we can. US rank 1, I guess, is what it's staying as. Okay. And then you go into distribution. Okay, so now this is where Ben was talking earlier. Quartiles, quintiles, deciles, percentile, right? That's what range they fall into. So if we wanted quintiles, right? Let's say our investment strategy was we're going to buy the top 2 quintiles of ROIC companies using this magic formula. So we could click quintiles here. Okay. Click modify the rank. Right? And what you'd see here is we would have, you know, specific amount of companies that would fall into this first quintile, right? So down here we have about
100 something.
176 companies within quintile 1, or 177 companies within quintile 1, right? And then we might have another, 177 would be my guess in quintile 2, but we might have more. Right, so we have 178 in quintile 2. And so if you had a basket of 355 companies with the top ROIC, obviously that's a lot. And it's because, again, our market cap is only greater than 150 million, right? If you're at a giant hedge fund, or you're at Fidelity, or you're running funds and you're trying to buy up companies, one, you're not going to buy 354 companies to put into that portfolio. But two, you're also probably not going to buy anything with $150 million market cap, because you're going to need it for a bigger fund. You're going to have more money to throw around, right? You need to find different things. So we could definitely screen this for other options to reduce our screen down, right? We could do some of those different options. But so this is what quintiles look like. But in the magic formula, a lot of times what we look for is actual rank. So what you see is if we go back to the top in ranking options, instead of quintiles, we click rank, and then click modify rank again. And what you're going to look for is the top 50. Okay, so this way you automatically get the top 50 companies with the highest ROIC. Okay. And then you can go through each of those companies and that can narrow down your list, right? You just went from 8,000 companies in the universe plus all the way down to 50, right? Very quickly. And you ranked them. And so you see on the side here, you have this rank. You can go down to the top 50 and you can just look through all these companies to figure out what's going to generate the most return for you moving forward, right? So then that's going to be the part where looking forward, right? Ben showed us how to do back testing, right? So you could back test this group of 50 and see how they perform. Or you could take this group of 50 and then break that into quintiles, right? You could just take like top 10, 20, 30, 40, 50, right? Of that and see how those performed, right? In the back test. But moving forward, that's unknown always, right? You never know how things are going to do moving forward. So that's where it's your job as analysts to start doing some research on these companies and figure out what's going to drive the outperformance moving forward, right? Has it all gone up? Is this company just like a cash cow that's just sitting on return on invested capital, but isn't really going to grow? So the stock price is going to stay the same, right? It might get a healthy dividend, but the stock price isn't going anywhere, right? Or is this company one that is still growing on that ROIC and is going to continue to generate return for me moving forward, right? And you can even see how they've done maybe year over year, or figure out how they do over the last 10 years, right? But that still only tells you the past. And so looking to the future, you still never know.
And so a quick adage that I think really sums up why screening is important is, while all 50 of these stocks might not be the next thing that outperforms the market, but what you're trying to do with a screener is, the way you get good companies is by shopping for them in a good store. And basically, if you have a good screener that performs well based off of like the back testing, what you're saying is that you're going to be picking good companies from a good list. So the likelihood of you messing up really badly and picking up, I don't know if something that went bankrupt. I don't know. But like
Plenty of things go bankrupt, right?
Yeah, like picking something that ends up like tanking over the course of the period is very unlikely. And so that's essentially what this is. I don't know what the exact saying is. It's like you don't look for bad food in a bad kind of store.
Good homes in a good neighborhood.
Yeah, something like that. I don't know. But you're basically making sure that you're looking for things in an area that is already very good. So you can't really go wrong. And you're trying to limit your potential downside on that.
Exactly. So yeah. This might not find you the next Amazon, but it'll definitely help keep you away from, the many shipping companies that went bankrupt, or
Yeah.
like shipping container or oil companies that come up and just go away.
Nikola.
There you go. Right? Like, you avoid companies that are going to do really poorly, right? These companies might not outperform, but at least their underperformance will be minimal, right? So you're in a safer place with the companies that you've screened for, the companies that you're looking at. You've already started ahead compared to the entire universe, where who knows how many of those companies will go bankrupt? Who knows how many of those companies will do well, right? You've screened for something that has been historically known to maybe do better, right? And so now you saw Bloomberg up, right? You want to show them how the back test would have worked on this magic formula? I think it's from 2019. So I'll stop sharing this.
And I'll just share this quickly. All right, can you guys see my Bloomberg? Yeah. So if you go to EQBT, which is the equity backtesting thing, and what you can do is you can go to create model, and then with this one, I've already made this screen, and so I can just start typing magic formula. You guys would probably need to go to the EQS function and save it, but we're just trying to show this for illustrative purposes. And then what you can do is the analysis period. You can go back. We'll look back 10 years on this, and then we'll rebalance annually on this one. So it means every year it's going to run the screen, look for that group of companies, sell the ones that we have, buy the other ones. And so we'll update that. And then in terms of parameters, we'll do equal weight. But then what I'm going to do is I'm going to run it against the benchmark of the S&P 500 index. And that's just a way to know that your opportunity cost. Because if you invest in something that performs worse than the market, if you would have just invested in the market, you would have done better. So we can update that there. And then at the bottom, once we have that, you can just hit run model. And then when you hit run model, it's going to ask you for a name. You just put the name in, do it. It'll take a little bit to run, but then once you're done, up here you'll get a message, and then in the message you'll go and you'll actually get the back testing model there. And so as you can see with this model, it did generate over the past 10 years 123% return, which isn't bad. Like, you're not losing money, but if you just would have parked it in the S&P 500, you would have made over almost 300% return over the same period of time. So that is it's not what's that saying is that it technically underperformed and did not do as well, but that's where you can look into and see maybe did the top two quintiles actually outperform. And so with this, you can see based on the yearly basis that it underperformed every year except in 2017, where it generated 2.5% outperformance. And with this, you can actually go through and see how many are being added in and being removed. And then you can also go and see exactly what trades were being made during what date. So you can see which ones were actually being included in and when they were being excluded. And so you can see this one bought a lot of companies because you need to limit it to buying only the best 30. This one just went with all of them. And so it sort of makes sense that it underperformed here. And so this one can't do as much as the FactSet alpha testing because you can't break it into the quintiles and all of that. But what you can do is you can just get a general overview of how the screen would perform over a given period of time. And so it can be that can be super helpful with that. And you can run multiple ones as well. I was gonna say, if I can run a different screen, you can see. You can run it, and I'll just run this one again, and you can see how something goes. So it's a very powerful tool just for like testing out ideas and strategies as well. And this is something that everyone has access to if you can either have Bloomberg Anywhere, or if you come actually into here to the Cutler Center, because I think alpha testing is like on top of the already expensive $20,000 a year for FactSet. It's like an additional $20,000 a year, so it's pretty expensive. And this is like a very good very good application to use.
And if you want to break it down into quintiles, right, you may not be able to see how the second quintile performed on its own, but you technically could see how the first quintile did by only taking, say you want the top 50, but you only take 10 companies, right? You've now seen how the first quintile performed over that period. Now let's say you want the first and second, and you want a 20 company basket, right? Out of those top 50, you take 20 companies, you run it with that, you basically have the top 2 quintiles. So you can back into some of those other testing. You just can't find each quintile on its own, right? But you can find the top 2 together. You can find number 1, right? And you don't have to see the rest if those ones are outperforming, right? If those ones are underperforming, and that would tell you that the bottom quintiles were performing better, that might mean that whatever you screened for isn't all that important in the market, at least for the past 10 years, right? Whatever you screened for, right? We just used ROIC, super simple. Okay, it wasn't a comprehensive screen in terms of what we were looking for and really like breaking it down by tons of different metrics to figure out what would outperform, right? Because like Ben said, right, if we keep making models that are closer and closer to that beating, or we only make a model designed to beat it over the last 10 years, we might miss out on what would outperform over the next 10 years. So it's always keeping that balance between being overfit and finding something that works.
So here's an example of. So what I did on this one is this is actually just a screen that picks up companies on the RSI when it drops below 30. So if anyone's out there that likes doing like technical analysis trading, you can actually backtest certain strategies really quickly, like what I did here. And as you can see, I mean, you could play around with the timing, but this one was rebalanced monthly and backed up against the S&P 500. But I think it was after, this was a 5-year, 5-year thing, you can see that it actually returned negative 18% versus the market. It was beating it very heftily there in 2018, but over this past bit, because of the bull market, that's there was probably a reason why these companies were going down and being oversold. So it's like it's just like a quick way to basically see. You can test out basic strategies like that. Like you could also do the MACD strategy. You could go RSI. You could do Bollinger Bands on their own. So if you guys are interested in that, you can basically see for yourself which ones perform well, which ones don't perform well. So just a quick thing off that. So
and all those are like technical indicators, as Ben said. So if you're looking for, in the BCF, we look for fundamental, like bottoms up type company deals. If you're looking for stuff like to play around within your Robinhood, you might start playing around with some technical indicators, right? And figure out, maybe you can find some that have outperformed over time. Maybe you can find a strategy where you're like, oh yeah, this has done well over the past 10 years, something that's at least performed positive, right? If we just did this RSI thing, it's performing negatively in a good market, right? It's performing negatively because we're in a good market. That tells you like this strategy is extra bad. Right? Like using this strategy on its own, extra bad. Because if I just bought the market itself, it's a good market. The market's going up. This strategy is yielding negative returns. Like I'm losing money and the market's going up. So my actual return here, right? We have 112% return on the S&P 500, negative 18. You didn't lose 18%. you lost 140 or 130,
Yeah.
right? You lost 130 because you also have the opportunity cost of that money going up by 112% and you lost 18. So make sure that you're paying attention to how my strategy would perform for that purpose, because the opportunity cost is just as important as the actual return.
Yeah. So it's just like a quick thing to put in mind, because the reason I showed that is because you can like look, if you like look at the RSI, just glancing back, this is what I was talking about when you do manual back testing. It looks like it does well. It looks like it should perform. But when you actually run it without taking your subjective like views and objectively run it, you can see that actually it's not that great. So on its own. So I'm not knocking the RSI at all, but I'm just saying by itself, if you just blind trust it, you're probably leaving yourself astray.
And that's the same for all screens, right?
Yeah.
If you blind trust any screen, it won't work. I promise you right now, like you're not going to get it. You can't blind trust a screen. If you find one company from your screen and bet the farm on it, you better hope that it's going to work, because honestly, at that point, you're playing darts, not investing, right? And so don't blindly trust a screen. Do your research afterwards. Use the screen to help you find those good companies, right? A good house in a good neighborhood. Then your job is to find the one that's maybe the most undervalued in that good neighborhood. One that doesn't trade like its peers do in that neighborhood.
Yep.
One that, has fundamental reasons as to why it's going to be outsized performer moving forward. That's what you're looking for after you screen.
Yeah. You're trying to find the mansion that's worth 300,000 while everything else around it is worth $1 million. And then you know that it's eventually going to be worth $1 million. So say that's the idea with the screen. Is there any questions? We've talked about a lot of stuff right now that we can go
Stop
over.
sharing the screen.
Yeah, I'll stop sharing so we can see you guys and see if there's any questions that anyone has. Yeah,
Yeah.
Arya?
Yeah, so I was wondering that
Oh.
just to take a small example over here.
Oh, wait, hold on, we can't.
Try now.
Yeah, try now. We can't hear you.
Can you hear me now?
That's probably us. That's why we can't hear you. Sorry.
Try one more time.
Can you guys hear us?
You want to try one more time, Maria?
Can you hear me? Can you hear me?
Yes, there you go.
I was wondering if we want to screen a company for 10 years or maybe 5 years. So if we are applying any of the metrics over here, like say just for an example, we took P ratio to be greater than 0. So if we want to basically find companies who have delivered this consistently over 10 years, then is it possible to add that kind of a filter on FactSet and see?
So you're saying a company that's had positive earnings, right, for multiple years? Is that what you're asking?
Yes, and
Okay.
way to check if a company has consistently delivered those things rather than just checking the performance for 1 year.
I'm gonna just check.
There's like different screening criteria that you can be like earnings per share has been growing for the past 5 years or something like that. Like, so you can say like has been positive for the past, like, I don't know, however long you want. There's like screening criteria for it. I just got to remember what it's called on FactSet. I think it's like historical profitability or something like that.
Yeah.
I can't
So like you can click into this and you can play around with like the year. And so like you can look into 10 years ago, 5 years ago, 4 years ago. And so basically what you could do is you could put in like greater than 0, and then you could do 10 years, and then you could do that again, and you could do 5 years, and then you could do it again, and you could do like 1 year, and then you'll have all 3 data points in for that. And it's only going to bring you companies that had it greater than 0 10 years ago, 5 years ago, and 1 year ago. So it's kind of like it's an annoying process to back into it. But like if that's what you're looking for, you can do it that way, right? You can take the 10, the 5, maybe the 3 and the 1, and then it's only going to yield companies that have those 4 criteria met. And so that's a way that you could kind of back into it. I don't necessarily know a way to do it all at once. Another thing that you can do in FactSet is like, I don't know, if you want it to be like greater than, instead of 0, you can use another formula here, right? So if you want the PE of this year to be greater than the PE of last year, you can do formulas like that to make sure that the company is growing over time, right? If that makes sense.
Yeah, sort of like an Excel function,
That makes
if
sense.
you be,
Thanks.
if you may.
Yeah. Okay, any other questions?
Yeah, is there any other questions? In the group?
It's clear? Okay, Leslie, do you want to hop in with your
Yep.
your fun facts?
My- A couple of
see, we
fun
can't hear
facts
Leslie.
before we wrap up today.
Wait,
So-
hold on, Leslie, we can't hear you,
Okay.
we're messing this up.
Can you hear me?
Hey, try it now.
Can you hear me now?
No. Why?
No?
I sent it to the left projector, Leslie, I swear.
Send it to the left.
Oh. I know why.
How about now? Good.
Okay,
Can
try
you hear
now.
me?
Yeah.
Yeah, good. Okay, couple of fun facts before we wrap up. So thank you everyone for joining. I want to quickly thank Tyson and Ben for hosting today's session. This will be our last Finance Lab 101 session for this semester, but we are going to be planning to do more in the fall. So hopefully you'll all join us then. Before wrapping up, I want to mention 2 quick things. So first is that all students can have access to FactSet on their laptop. So if you don't already and you are interested in gaining access, please send me a quick email with your name and expected graduation date, and I can reach out to FactSet and get that going for you. Second thing is that we did record today's session. So for those of you who maybe don't have access to FactSet, once you do gain access, you want to go back to this recording and go through it again, you can certainly do that. You can access the recording as well as many other tutorials that have been developed by our Cutler Center assistants, and the recordings of some of the prior Finance Lab 101 sessions on our website. So if you go to the Cutler Center Finance Lab page and then you click on the guides page, you'll see everything there. So I would recommend checking out those resources on your own time and going through some of those exercises. So that's it for today. Again, thank you to Tyson and Ben, and thank you to all of our participants for joining us. I hope everyone has a nice weekend.
Thanks, everybody.
Yeah, thank you so much, thanks for swinging by.
Thank you,
On
guys.
Friday.
Thank you.
Thank you.
Thank you. Thank you.